Good morning and welcome to the Mini Storage Messenger Self-Storage webinar series. I'm Poppy Behrens, publisher of Minico Incorporated, and we're delighted to have you in the audience today. This is one of our regularly scheduled webinars for self-storage owners, operators, managers, investors, developers, and other industry professionals.
Hey, Poppy, I got to stop you. You're really cracking up.
Really?
Can you jump off your phone or your headset for me?
Okay.
Sorry, guys. I figure if we're going to re-record, we should do it.
Yeah.
Okay, is that better?
Just give me your opening sentence.
Welcome to the Mini Storage Messenger Self-Storage webinar series.
Totally. I'm not sure what was going on there, but is that going to be okay for you for the first 4 slides?
Yeah, that's fine.
Okay. I'll just have KJ edit it for us when we're done.
Okay.
You can just count to 5 and start talking.
Okay. All right. Good morning and welcome to the Mini Storage Messenger Self-Storage webinar series. I'm Poppy Behrens, publisher of Minico Incorporated, and we're delighted to have you in the audience today. This is one of our regularly scheduled webinars for self-storage owners, operators, managers, investors, developers, and other self-storage industry professionals. The sponsor of today's webinar is Los Angeles, California-based Watermark Financial Incorporated, a company that specializes in the financing of self-storage properties nationwide. Our presenters are Georgia Ragsdale and Elizabeth Brayman. Georgia Ragsdale is the CEO and a founding principal of Watermark Financial with over a decade of commercial real estate experience. Georgia has a strong and proven track record in self-storage, land development, multifamily, construction, and commercial real estate investments. She is an exceptional speaker, presenting sales training to Fortune 500 companies such as IBM, Charles Schwab, and Bank of America nationwide. Georgia is an active member of the California Self-Storage Association and is a speaker at industry conferences. She has also been published on finance-related topics in several leading publications, including the Mini Storage Messenger. A native Texan, Georgia is a proud graduate of Southern Methodist University. Elizabeth Brayman is Vice President of Watermark Financial and also one of its founding partners. She closes over $100 million yearly in commercial real estate financing. With nearly a decade of commercial real estate experience, Elizabeth is knowledgeable in complex real estate investments, self-storage, multifamily, construction, and equity and debt financing. She is a certified commercial investment member and currently serves on the Los Angeles Chapter Board of Directors of CCIM. Elizabeth is also an active member of the California Self-Storage Association and has spoken at self-storage conferences across the country. She is a graduate of the George Washington University Law School and School of Business, earning her JD and MBA in finance. Elizabeth also attended the London School of Economics and received her undergraduate degree at the American University. This year marks the 30th anniversary of the Mini Storage Messenger, the original voice of the self-storage industry. Each issue of Messenger provides readers with in-depth news and information. It covers stories and feature articles that explore the most timely industry topics and trends. In addition, monthly columns contributed by industry experts and accomplished business professionals address a wide range of topics including security, facility operations, technology, legal issues, legislative updates, construction, and development. We also publish a variety of other self-storage data sources, such as the ones you see on your screen. For more information, please visit ministoragemessenger.com. Today's webinar is being recorded and will be available for viewing on demand from our archives at ministoragemessenger.com. We invite you to submit questions throughout today's webinar. To do so, simply type your question into the question area and click Send. While we will try to answer as many questions as we can during the Q&A period at the end of the webinar, those that cannot be answered due to time constraints will be answered by way of email after the webinar. Today's presentation should run about 45 minutes with the remainder of the hour open to questions and answers. And now I'd like to turn the presentation over to Georgia and Elizabeth. Good morning, ladies.
Hi, thank you, Poppy. Thank you for coming, everyone. And Poppy, appreciate the kind introduction, and also to Minico for having us here today to present this webinar. We are Watermark Financial, and today our webinar is titled Refinance, Closing Self-Storage Loans in Today's Market. Our agenda for today is to start with a brief introduction. We'd like to present an overview of today's market, a discussion in the borrower's role in the refinance process. There we go. How to find a lender in today's market, what documentation you'll need to refinance, the appraisal process, the loan process, questions you should ask lenders, things to consider, ending with a quick look at how the market might recover. Then we'll give a few bits of good news before we take your questions and wrap up for the day. My name is Georgia Ragsdale, and I am the President and CEO of Watermark Financial, and I'll be presenting today with Elizabeth Brayman, our Vice President of Watermark Financial. I'll take the first half of our presentation today and then hand it over to Liz before wrapping up. And I'd like to start my presentation with a little bit of humor. In this slide, we have a cartoon showing a couple saying, when can we go back to wasteful consumerism fueled by reckless borrowing against our children's uncertain future? The answer is, it's going to be a while. To begin, I want to give a brief overview of today's market. Undoubtedly, there have been tremendous changes in the past 12 to 24 months. The pin that burst the bubble was the infamous subprime meltdown, which led us into a mortgage crisis. The market for commercial mortgage-backed securities, CMBS, or conduit loans, vanished beginning in August of 2007. In 2008, investment banking giants suffered catastrophes. Bear Stearns in March of 2008 was forced into a fire sale to JP Morgan. In September of 2008, Lehman Brothers failed, sending shockwaves through our entire banking system, after which Goldman Sachs, Freddie, Fannie, AIG, and others were saved by a government bailout. Fearing a total collapse of the financial system, the government created the TARP program, $700 billion in bailout funds, and most recently completed a stress test on the banks, asking most to raise more capital. The stock market has fallen dramatically, and most recently has shown some nascent signs of stabilization. But in short, we have suffered a financial trauma, and we remain in a volatile market. For those who'd like more information on this, there's an excellent documentary created by Frontline called Inside the Meltdown. You can watch it in its entirety online at the website pbs.org. Since there is virtually no secondary market for commercial loans right now, which means all of the loans for self-storage and other property types that previously were securitized and sold off now fall squarely upon the banks, some insurance companies, and limited other sources to finance and refinance. The global crisis has resulted in a huge loss of equity in the market worldwide. This means less money available to lend from fewer sources. And this in turn, of course, causes fewer buyers. And investors' money doesn't go as far if you can't get enough debt to leverage the property. And this has led to significantly fewer acquisitions. So a combination of the low leverage, current cost of capital, and hence fewer buyers has impacted cap rates for self-storage. Buyers are simply not buying. Commercial property sales volume dropped 73% from 2007 to 2008. That is a massive shift. And 2009 hasn't been much better. Now let's consider what the drop in property values means to banks. If the banks lent on commercial real estate in 2005 or 2006, for example, and the property values have since dropped 10 to 20%, the bank's portfolio is over-leveraged. With the feds now demanding more capital to ensure that the banks are solvent, most banks will need to raise significant capital to balance out their debt-to-equity ratios. Here's a slide that shows us what we have in store in the next few years. This is the entire volume of commercial loans maturing by year. I'd like to mention something not shown in this slide. Of these figures, the numbers are particularly staggering for the CMBS maturity, and I'd like to share these numbers with you. If you look at 2009, $40 billion of this is CMBS maturities. In 2010, we have $45 billion. In 2011, $52 billion. In 2012, $65 billion of this number, and it jumps to $100 billion in 2015. $131 billion in 2016, and $136 billion in 2017. If the secondary market does not return for commercial loans, where will all of this debt go? The banks simply do not have the funds to refinance existing and new debt, as well as take on all of these CMBS loans. Here's a quick slide to show visually the drop in sales volume. We're seeing an anticipated uptick in projected 09 numbers from 2008. Hopefully this will bode well for some recovery. The results of fewer lenders lending, fewer sales transactions, and more stringent lending guidelines, as shown on this slide, we have a graph that shows the steep drop in commercial real estate loan originations from 2007 to 2008. Here, each bar represents a quarter and is shown in billions. The next slide shows who is lending in today's market for acquisitions. Note Wall Street went from providing 33% of the debt in 2007 to a mere 1% in 2008. National banks have gone from 26 to 8%. International banks a modest decline, 18% to 15%. Alternatively, some previously insignificant sources of financing have grown significantly. Fannie and Freddie have increased from 1 to 5%. Seller finance transactions have increased from 0 to 4%. And assumable debt has increased from 0 to 50% of transactions. Now, seller financing and assumable debt doesn't help those of you who own properties and need to refinance existing debt, either because you have a balloon note that is due or because you have a high rate. So how are rates? Rates today are still relatively low, but one should not confuse the low Treasury rates with low lending rates. The Treasury, like Prime and LIBOR, is an index. The banks charge a margin, which is the difference between the cost of funds and the rate charged to consumers. This is the bank's profit on funds they lend out. Because the banks are suffering in this climate, the margins have been increasing to cover previous losses and to provide greater liquidity to the banks. I skipped over it quickly, but on the previous chart, the 10-year Treasury continues to drop while the commercial real estate borrowing rate is rising. Now, what other effects have the economy had on self-storage? This chart shows the nationwide drop in occupancy rates for self-storage. I'm sure many of you listening can attest that occupancy, physical and economic, at your facility are either flat, dropping, or some way struggling a bit. This affects the bottom line, your NOI. With dropping NOIs and fewer sales, as this chart shows, cap rates on self-storage are rising nationwide. Before we start talking about refinancing, this chart gives a little context to where we have been compared to where we are now. The average rate on a 10-year fixed was 5.25% and is now 7.5%. Amortization used to be 30 years or interest only. Now it's 25 years and even 20 years on some loans. The market cap rates were around 6%. Now we're close to 8%, and some banks will even use a higher cap rate with the expectation that property values are continuing to drop. A net operating income of $400,000 may have dropped by 10%, leaving us with only $360,000 to cover the mortgage. At a 6 cap, our property is valued around $6.7 million. But at an 8 cap, with a lower NOI, the new value is $4.5 million. Our banks are now lending 65% of value as opposed to the 80% of value they used to lend, and our debt coverage ratios have increased from 1.15 to 1.25 to 1.3 or even higher. Loan proceeds have therefore dropped from $5.3 million to $2.925 million. In this scenario, we have a $2.4 million shortfall on the refinance. Should you find yourself in the situation of having a shortfall in your loan proceeds, you may be unable to refinance. If this is the issue, that the property is not yet stabilized, then we might look to get you a bridge loan just to get the property to lease up. Alternatively, you might have to bring in additional cash to pay down the loan, or find an equity partner to bring in cash. In some instances, you may be able to negotiate an extension or seek a reduction of principal amount with your existing lender in order to get them paid off. Where does that leave us? Conditions are not improving quickly. There's no magic cure for our current situation, but there are options. First and foremost, a borrower has to understand it's a lender's market. Prepare yourself and your property to conform to a bank's request. Regional lenders are out there, and there are some limited insurance funds, but they have limited resources and are few and far between. Be patient. Loans are not moving quickly in this market. And with that, I'd like to hand it over to Liz Brayman.
Thank you, Georgia. And hello there. Again, my name is Liz Brayman, and I'm going to follow Georgia's lead and kick off my portion of the presentation with a little bit of humor. Here we have a cartoon showing the borrower asking a bank, "Let me get this straight. You want to offer us financial advice?" It may be hard to imagine the banks giving you financial advice. They really aren't in the best of shape themselves, but they will. And that is something that you as a borrower need to prepare yourself for. Let's start by asking yourself, do you need to refinance? It's a simple question. How about, is now the time for you to refinance? You should ask these questions in a good or a bad market. How about, how much time do you have left on your loan? How are your current terms? What is your current rate? What is your goal with the refinance? Are you looking to change your rate and term? Do you need to cash out? Are you looking to rehab the property? Most importantly, are you ready to refinance your current loan? Let's quickly go over some of the reasons why you might not be ready to refinance. What things might make it tough for you to refinance in this market? If your property is not stabilized, there may not be sufficient cash flow to support the loan amount, and the lenders do want to see some historic trends. 2, if you built the property in the last few years, again, the cash flow may not be there, and there's no historic data to show the lenders. What is most difficult with new construction properties is that you may not have tax returns to show the bank. Lenders love tax returns. They believe that you won't lie on your tax returns to your detriment, whereas it's easier for a borrower to fudge a little on the profit and loss statement. Number 3, if you have purchased the property in the last few years and have a high leveraged loan, this may make it difficult for you to refinance. Even if you have a stabilized property, if you put very little down at purchase and the property value stayed the same or went down, you might have a tough time refinancing under today's current parameters. Number 4, if your property was stabilized and now is suffering from a big loss in occupancy, or you had to drop rents, this is a cash flow issue. You must hit that 1.25 to 1.3 debt coverage in order to get the loan amount you need. Number 5, if you have other properties that are in distress, this is a huge red flag to lenders. They don't want to lend to you on a property that isn't in distress when you have other properties that might eventually bring you and your stabilized properties down. Number 6, if you need a non-recourse loan. Non-recourse loans are very difficult in this market. If those are the people who aren't ready, what are the attributes of someone who is ready to refinance? If the property is stabilized, if you bought the property over 3 years ago and haven't added any debt, no seconds. If you put a lot of money down on your purchase. If your property is generating strong cash flow. If your property is in an infill or urban location. If you are willing to accept a full recourse loan. A refinance really focuses on 2 things, the borrower and the property. If both are strong, you shouldn't have any problem refinancing. Let's go over now what lenders want to see in a borrower who is refinancing. You should have good credit with no late payments and no bankruptcies. You should have good liquidity, which means you have solid cash reserves. The trick is you can't look like you need the money. Banks do not want to lend to borrowers who are in distress. Next, you should get yourself prepared for the new lender to ask for a depository relationship. As we previously discussed, The banks can't lend without corresponding balances to offset the debt on their balance sheets, so the lenders will look to have a relationship with you. You should expect to submit a lot of paperwork. We'll get to that in a minute. The banks have the feds watching everything you do, so they can't just lend on a handshake these days. It is good to be organized and ready to submit the requested information to the lender. Here are a few things you can do to prepare yourself if you personally aren't ready for a refinance. If you run your credit and it's below 620, then you can work on getting your late payments removed. Give yourself at least 2 to 4 months to do this. There are credit repair agencies who can assist with getting mortgage lates removed. Lenders don't want to lend to borrowers who have shown an inability to make timely payments. If you do decide to work with a credit repair agency, see if you can get a referral. There are a lot of sharks out there. Second, try to keep the bank balances high. Don't make any major purchases that deplete your accounts in the 2 to 3 months prior to a refinance. At the same time, you should have low contingent liabilities. Pay down your credit cards, no more than 30% of your available balance. You should not have an abundance of highly leveraged land or properties that aren't cash flowing on your schedule of real estate. These are red flags to lenders. Finally, talk to your CPA the year before a big refinance and make sure that he or she is not overly aggressive. If you show big losses, this can be a red flag to the lender and impede your ability to refinance. You may save some on your taxes, but it's not always worth it to jeopardize your ability to refinance. Here's a relatively new phenomenon for you to look out for, the debt-to-income ratio. The debt-to-income ratio, or DTI, used to be something we only saw required for borrowers seeking residential home loans. Now, some commercial lenders are requiring that borrowers meet a certain debt-to-income ratio, meaning that they want to see you as a borrower do not have debt obligations that exceed your income. This is done to ensure that they're not lending to borrowers who are in trouble financially. While for a home loan, the debt-to-income can be 45 to 50%, meaning your debt should not exceed 45 to 50% of your income. In commercial, they're usually a little more generous, allowing you to have somewhere between 50 to 100% of your income to your debt. Once you as a borrower are ready to refinance, take a look at your property to see if it's ready too. In a year, on the very least, few months prior to a refinance, you want to get the property prepared. Do everything you can to ramp up your rental income with high occupancy, high rental rates, and lots of product sales. Also, reduce any extraneous expenses. Make sure every expense you have is absolutely necessary. Your goal, and this is paramount, is to maximize your NOI. Your NOI is critical to ensuring that you have favorable appraisal and will have the income to justify maximum loan dollars. So how do the banks determine your loan amount for a refinance? There are 3 ways the lenders generally come up with your maximum loan amount. The first is loan to value, the second is debt coverage ratio, and the third is loan to cost, although this one's almost only used when you have a construction or newly built project. Let's go over these 3 loan determinants. The loan to value, or LTV, is the maximum loan amount relative to the value of the property. Usually the lender will give you an LTV max, such as 65%. This means that they will lend you 65% of the total value of the property as determined by an appraiser. LTVs in this economy average around 65%, but it's highly dependent upon the market you're in. Some markets are lending at 50%, some others are still at 80%. So you need to check with a lender or mortgage broker to see what lenders in your market are offering. You can get a good idea of the value of your property by taking your NOI and dividing it by a cap rate. So if you have a $100,000 NOI and an 8.5 cap market, divide the $100,000 by 8.5%, and you'll see that your property is worth $1.176,470. And at 65% loan to value, you can get a loan of about $764,000. The second determinant is the debt service coverage ratio, often referred to as DSC or DSCR. The debt coverage ratio is the ratio of cash available for debt servicing of principal and interest. We used to see a 1.05 to 1.15 debt coverage, But in this market, it's more likely you'll see a 1.25 to 1.4 debt coverage ratio. If the lender gives you a DSC of 1.25, you can determine your loan amount by taking your NOI and dividing it by the ratio to see your maximum annual mortgage payments. Now it gets a little tricky. You either have to use a financial calculator or a mortgage broker to determine the loan supported by the mortgage payments for a loan at a given interest rate and amortization. For example, if you have $100,000 NOI and a 1.25 debt coverage, you divide the $100,000 by the 1.25 and end up with $80,000 available for your annual mortgage payments. Divide that by 12 to get your monthly mortgage payments, and then use the loan amortization and the rate to solve for your maximum loan amount. And very quickly, the loan to cost really only matters for properties that are 2 years old or younger from construction or purchase. A few lenders don't want to see borrowers pull out their entire cash investment in a property. When you do so, it makes it much easier for you to walk away from a property because technically you don't have any cash to lose. So the lender may require you to keep some equity in the deal. Go ahead and ask your lender. If they, for example, require an 80% loan to cost, you'll need to keep 20% of your purchase price or total project cost into the deal. When you and the property are ready to go, you need to find a lender. We suggest working with a broker who understands self-storage, like Watermark Financial. Why a broker? We get that question a lot. We spend every day, all day, working to find the money, and in this market, it moves around quickly. Allow a broker to share with you their requests, their knowledge of lenders and products, as well as to package your loan request in the most favorable light. An extra 1% to a broker today is well worth the money you can save in the long term. If, however, you have long-term banking relationships with a bank where you keep your deposits, you should ask them to provide you with a quote on the property. Sometimes that relationship can translate into a great refinance offer. What's most important is to build a relationship. It really is a team effort to get successful financing in place in this market. What do you need to put together a successful loan package? Again, it's back to the borrower and the property. You want to present both in the most favorable light. For the borrower, the bank will ask for a personal financial statement, 3 years of personal tax returns, bank and brokerage statements showing your cash position, a schedule of real estate showing all of your real estate holdings, and a credit report that shows how much liabilities you're carrying. For the property, the bank will want to see a management report to see economic and physical occupancy, a rent roll to see what units you have and what is leasing up, a profit and loss for the last 3 years, as well as the year-to-date, a balance sheet for the property for the last 3 years and year-to-date, and 3 years of tax returns on the property. When putting together your profit and loss to go to the lender, here are a few things to watch out for. First, separate your yearly maintenance expense from capital improvements. Your lender should do this for you, but they may not. Maintenance expenses are your average annual expenses, the things you spend to fix up your property. A little paint here, some new fixtures there, nothing significant. Your capital improvements are big expenses that you should not expect to have every year. For example, new doors on your unit or repaving the property. Capital improvements should not be included in your NOI and can often distort your NOI greatly. Second, take a look and pull out all non-recurring expenses and put them in a separate line item. Things such as the lawsuit, audit expenses, a temporary change in vendor, anything that causes a line item to be extraordinarily high in a particular year. You should pull it out and give the lender an explanation. After you submit to the bank for pre-qualification, at some point, you'll need to provide additional documentation. So it's not a bad idea to get it ready. Items such as insurance, your current loan statement, a grant deed or legal description of the property, an old appraisal and or feasibility study if available, and any legal documents will be needed to close your loan. The appraisal process is hugely important to the success of your refinance. While by law the appraisal is ordered by the bank, you as a borrower have a huge impact on getting to maximum value. First, do your homework. Well, you can just leave it to the appraiser to do all of the work. What if he or she doesn't? You, as the borrower, will be the one who suffers. So pull together all the comps, market data, and management reports you can. You can also clean up the property, just like you were selling it. The appraiser can be affected by having the best possible property. So clean it up. Tidy the office, clean the property, put on some fresh paint if it's easy. You could end up adding some much needed value to your property. And finally, as the borrower, you can really put yourself in front of the appraiser. The appraiser is a person just like you. So be nice, be friendly, and be very helpful. One of the biggest issues for appraisers in today's market is the lack of comps. This makes it very difficult for them to do a good job. If you own self-storage and the most recent sale occurred 100 miles away, how can this be used as a good comp? Or what if the only sales in your market occurred 12 months ago? How is that a good comp? Without a robust volume of sales, it is very difficult for an appraiser to know how much your property could fetch on the open market. So what do appraisers do without comps? Appraisers are relying heavily upon cash flow. They're looking outside of your market and pulling from sales 12 months or older and then making adjustments to reflect the current market. Once again, and we can't stress this enough, do your best to maximize your NOI. Prepare for your refinance 12 months in advance. Talk to real estate brokers and other operators in your market. Appraisers are simply reporting data. They're not making up the data. And you can help them by making sure that they have all the data that is available. The appraisal is an opinion of value, and you want to support the appraiser's favorable opinion of your property. So how long are loans taking these days? This slide shows a quick timeline. Notice that the overall loan process has gone from 30 to 45 days to 45 to 60 days from receipt of a signed and returned letter of intent. Notice that I've qualified the start as a returned letter of intent. It can take weeks or months to find a lender who is interested in your project. And some borrowers take weeks to return a letter of intent because they want to weigh all of their options. The stopwatch starts once the two parties, borrower and bank, have decided to move forward together. When you get an offer from a lender, you should make sure you have asked them some important questions. This is where working with a good mortgage broker can help to make sure that you don't make any mistakes and fail to ask anything that's relevant to your situation. Good questions to get answered from your lender are, how many deals are they closing a month? In this market, it matters. If the lender isn't closing deals, you may want to be suspect that they can perform on a term sheet that has been presented to you. Obvious questions are, is the rate fixed or variable? What index and margin is being used? Is there a floor or a ceiling on the loan? Does the loan have a balloon? If not, what happens after the fixed period? Most fixed loans that are fully amortizing turn into a variable after the fixed term. You should ask what index and margin will be used at that time. You should ask the lender, what are they using for the debt coverage ratio, the loan to value, amortization, what are the prepayment penalties, and what origination fees and loan fees will be charged. As a mortgage broker, we can help you compare different loan options by doing a side-by-side analysis to get you the best possible option for you. And here is some useful information. Warning, ask your lender what assumptions they're using to determine your loan amount. Many banks are now using stress rates for cap rates and underwriting your loan. For example, your property may be at a 7.5 cap per the appraisal, and the bank is offering you a 6.5% rate fixed for 3 years with a 25-year amortization. That all sounds good, but they may underwrite the loan as a 9 cap with a stress rate of 8% with a 15 or 20-year amortization to get to their 1.25 debt coverage. While they offered you 65% LTV, they may only get to 50% using their internal stress rates. Ask your lender and be prepared. Another important thing to note is a major change in the policy of lenders when underwriting your refinance loan amounts. This is a big warning. Let's talk a little bit about what is brought up quite a bit these days. Recourse loans. With the fall of the CMBS market, there are very little non-recourse loans available. Life companies offer some options, but they're not lending heavily on self-storage these days and mostly want larger loan amounts. We do have some limited non-recourse options, but the leverage may be very low and the borrower very strong. Rates on non-recourse are generally higher than full recourse. So ask yourself, do you really need non-recourse? California, for example, is a single action state. Ask your attorney if there are any ways that you can limit your risk while personally guaranteeing the loan. We're not recommending that you do or do not need a recourse loan. It is just worth knowing all the facts. As you go into the refinance process in this market, there are a few things to consider. First and foremost, where are rates going? If we end up with hyperinflation in 2 or 3 years because of all the money, should you take a shorter term rate and risk having to refinance when rates are low, or take the higher, longer term rate? Where will interest rates be in 3, 5, 7, 10 years? What kind of leverage will you get in 3, 5, 7, or 10 years? And with that, I'll hand it back over to Georgia.
Thank you, Liz. Perfect time for more levity. Let's shift to another cartoon showing a Lassie lookalike communicating some important news. What's that, boy? A paradigm shift? We are in a time of change. Without predicting the future, we can share that economists are expecting the current recession to recover with an L-shaped curve. As you can see in the chart, the 80s recession was a U-shaped, which means that we had a quick dip with a swift recovery. The 90s recession had an L-shaped recovery, which in that case was a decline with a slow recovery. Our current recession looks like it will follow this L-shaped pattern. We'd like to end every presentation on an upbeat note with some good news, which isn't always easy in this market, but there are opportunities. What is the good news that you can take away from today's presentation? It's a great time to buy. Prices are down, which means there are opportunities to be had. If you have equity in your property and you're able to do a cash out to purchase another property, or if you have cash on the sidelines, it wouldn't be a bad idea. Second, rates are still low, and there are still lenders lending. It may take longer to find, but they are out there. And finally, the most important consideration, self-storage remains a well-performing sector relative to all other commercial real estate. And to prove that point, here is a slide showing sector returns as of February 09. Self-storage is outperforming almost all of the other sectors and remains one of the lowest defaulting property types. And with that, we're going to conclude our presentation on self-storage refinancing. Feel free to call us if you have any financing needs, whether for self-storage or other commercial property types, or just to run a scenario past us for feedback. We offer services on projects nationwide and can be reached at 310-479-1260. Thank you for listening in. A special thanks again to Minico and Poppy for having us. And now we'll open it up for a brief question and answer period.
Thank you very much, Georgia and Liz. Great presentation, and we have a lot of questions that are being asked. Question number 1, what term are most refis going for? 3, 5, 7?
That's a great question. The 3-year shorter-term loans are priced more aggressively from the lenders, but most of our borrowers are seeking a 5-year term minimum. They just don't feel comfortable with a 3-year loan, not knowing where interest rates will be in 3 years. So most are seeking to pay a little bit more for the 5-year note. If possible, some folks are locking in at the longest rate that they can tolerate. That's a good question.
All right, second question. You asked that we ask banks how many loans they are closing. How many are you closing on self-storage, and what are the typical terms?
That's another good question. Refinances are taking a while. The loans that are closing are taking longer than anyone would anticipate once we get started. But the answer is yes, loans are closing, and most of the terms are 5-year terms. The interest rates are varying between 6.5 and maybe 6 3/4.
Okay, Liz, any comments from you on that?
That's about right. We're also doing a number of development loans this year, which I guess we're not seeing as many acquisitions as we have in the past, but we are doing a lot of refinance, and we are doing quite a bit of construction financing. Again, the borrowers just need to be very, very strong.
Okay, great.
Thank you.
Next question. We are in lease-up. What kind of lending is possible?
Well, that is going to be dependent upon the where you are in your lease up. If you're below 30%, that is a very tough spot. If you're showing trending leases and you're moving forward and you have a degree of income from your property and you can show that you're progressing, probably a bridge loan is going to be your best option until you get your property fully stabilized.
Okay, Liz, anything more on that?
Georgia and I are recommending to a lot of our borrowers in this market that if they do find themselves in that situation, that they talk to their existing bank and see if they can get an extension. There's not a lot of options if you have an empty or an empty building or a property that has income that doesn't support the existing note. But you can either renegotiate the outstanding loan amount or get an extension. And as Georgia mentioned, there's also some bridge funds out there depending upon the strength of the borrower and the amount of cash flow that the property currently supports.
Wonderful, thank you. Let's see, next question is, you stated that you have investors looking for opportunities. Are they more interested in construction or permanent loans? And are they looking for equity or just a rate of return on funds borrowed?
That's a little bit of a two-part question because the word investor can mean a couple of different things, and I'm trying to understand which you mean. Investor can mean an equity participant who's interested in investing their dollars in self-storage, looking for opportunities, or an investor can also mean a bank, a lender. When we speak of investors, I think we used it in both senses during the presentation. When we say investors are on the sideline, there are a lot of well-capitalized top operators and other equity groups waiting to make opportunistic purchases in the self-storage sector, waiting for that opportunity to acquire a property that they feel they're getting a tremendous buy. On the other hand, investors, meaning lenders, there are investors, meaning lenders, providing funds into the self-storage sector, and that means a range of banks and other lenders such as bridge lenders, private money lenders that are available to you. Liz, did you have anything else on that?
It's a big question.
It is.
there's a lot. We'd be happy to discuss that with you further. If you want to give us a call, we can talk through with you. We have investors who are looking for properties that are in trouble and would be looking to either acquire or invest in those properties. We have investors, meaning lenders, as Georgia mentioned, that can assist on those projects. So there's, to answer hopefully not too broadly, a very large question. There's someone out there almost for every project. It really just depends upon the projects and whether there is enough strength in the project.
Okay, great. Next question, how are lenders now looking at ancillary income at self-storage properties, whether it's the usual box and locks income or even perhaps business incubator or parcel services?
That's a good question, and honestly it does depend upon the lender. There's no uniform answer that we can give that will cover all of the lending options out there. I can tell you that if you are heavily dependent on ancillary income to show the profitability of your site, that it'll be pretty well scrutinized. Hopefully you've got a strong trailing record of the income from those sources, and if you have a strong historic record of that property performing in that sector, most lenders should accept it. Liz, did you have any other comments on that one?
No, for the most part, we are seeing lenders are, haven't changed much in this market. They're still recognizing and including that. Similarly, if a year or two ago, if you had showed some of that ancillary income, but it was new, then as it was then, it is today, that income may not be given a tremendous amount of weight, but that's to say most of our lenders will recognize it as long as it has some historic value to it.
Okay, great. In your opinion, are sellers recognizing these new lender requirements in terms in pricing and selling their properties?
In a word, no. It really is the brokers and the buyers' responsibility to help the sellers understand what the current lending environment is. We've seen a tremendous gap between what the sellers are asking and what they think is a realistic value of their property and what the buyers are experiencing from their side trying to get loans for these properties. And that gap is continuing to hold, meaning the sellers are being patient. They honestly don't really want to sell in this market unless there's some exogenous factor that's causing them to sell right now. And so that's causing the transactions to be very, very slow in coming. A few sellers do recognize what the situation is, and many times they're offering to take back paper in order to get a little bit better price for their properties. Liz, did you have any other comments there?
Sure. I mean, it's a tough market. Most of the people that are selling in this market are distressed sellers because, honestly, if you didn't need to sell, you might not want to sell in this market. So it may be less that the sellers aren't being reasonable and understanding as much as they're, not able to make the kind of concessions that buyers would like to see in terms of purchase prices and such. But, I mean, as George's slide showed, there's a lot of seller carrybacks going on. So obviously there is a good part of understanding on the part of the sellers that there needs to be flexibility and understanding that the banks are not being as loose with capital as they once were.
Okay, great. Next question, are there any indications that a modified CMBS program or other capital structure will develop over time to fill these current lending gaps?
That's the $100,000 question. And that's certainly something that everyone is working very hard on creating. Clearly, if you can see how many loans in the CMBS sector are coming back up for refinance, we need to create some kind of secondary capital structure. And we're constantly seeing news come out, little dribs and drabs here and there of what is going on in that sector. And the answer is yes. People are working very, very hard on creating that. It is not coming on board anytime soon, but it is something that is being worked on very much. The first thing we have to do is stabilize the pricing and the value of real estate. And once that occurs and we can establish a sound underwriting practice at the retail level, then the secondary market will begin to come back as people are willing to step back into that and buy those notes if they feel that the value is secure and the underwriting was sound. Then we're going to see a beginning of that come back.
Okay, great. Next question. Are there, what geographic areas or property types do you feel are presenting the best investor opportunities to get a sale and or a loan completed?
Well, that's a very complicated and good question. That's probably another topic for a great seminar, Poppy. The property types that are most easy to finance right now are those that can be financed by what are called agency loans, government-supported loan programs such as SBA, Fannie Mae, Freddie Mac. That means multifamily, and that means owner-occupied property types for small businesses who qualify within the SBA guidelines. Those are the most predictable, those are the most sound, those are the ones banks most want to lend on right now because the government backs a portion or all of their loan that they underwrite. So that's the number one choice right there. Some other property sectors that we see still performing well with money available would include self-storage. It would also include special use property types such as mobile homes, such as data centers. There's some others in there. Probably the property types to stay away from, which there's certainly good, very, very good deals to be had, but be very cautious in your approach to these property types would be office, and retail has been hit very hard, of course, and those are not anticipated to bounce back anytime soon. Liz, did you have any other brief comments on that?
Sure, I'll throw out some
Great
information on those agency loans. On the Fannie and Freddie and HUD programs, which we think are phenomenal for multifamily, you can get 80 to 85% leverage, 1.17 to 1.25 debt coverage, and we're seeing 10-year rates in the mid to high 5% range. So really phenomenal on that program. And as well for anyone who has a business, unfortunately not self-storage, but if you have any other type of business, the SBA is still lending 90% of purchase price or cost. So there's the opportunity to purchase a property that's, let's say, a distressed property that needs some work. They will lend to you 90% of the total project cost to rehab that property. And they have a 20-year fixed portion of that loan right now that's in the low fives, which is just phenomenal money. So we are doing a lot of SBA loans. We are doing a lot of agency Fannie Freddie loans right now. There's a tremendous amount of volume on those property types. And I would say if you have any questions on those, please give us a call.
Okay, great. Next question. What are cap rates on lower performing properties?
Well, that's a very complicated question. The answer technically is none. Technically, if a property is underperforming and there are no comps, it's not a stabilized property, therefore a cap rate that's in any way uniform really could not be applied. Finding the values of those properties is a formula that many different sources, there could be many ways to derive a property value on a property that's underperforming or that is not stabilized. And that could depend on some combination of cash flow, anticipated cash flow, modified to today's present value, any sales comps, replacement values, all kinds of things could be applied to arrive at a value for that property type. Melissa, do you have any other comments there?
Yeah, it's a good question because we talk to appraisers about it a lot, and it's you know, how do they come to a value on a property that's 30 to 40% occupied? And it's just the answer is it's very difficult. You have to use the existing income, project it forward, and then discount it, and it's a complicated thing. But cap rates, again, as Georgia mentioned, don't really apply in those circumstances.
Okay. Next question is, we have a newer development which is trending rock solid towards stabilization, but we are coming up on a need to take out on our construction loan, to do a takeout on our construction loan. Are we wasting our time trying to refi prior to 80% stabilization?
It depends on your numbers exactly, but if your loan, your final permanent loan is not going to be supported by your cash flow in the present market, and you're not willing or able to come out of pocket to make that loan payment every month, then you probably should just step into a bridge loan if you can't extend your construction loan another 6 to 8 months. Probably the easiest and quickest way would be to go for an extension if you can, and maybe you'll pay a little upfront origination for that opportunity. But after that, I would try a bridge loan until you can get to stabilized.
Okay, Liz, any comments on
Yeah,
that?
I'll just add to that. We'd be happy to take a look at that project and give you our thoughts, and that offer extends to everyone else who's listening today. We'd be happy to take a look at projects and just give you our 2 cents on what kind of loan amount we think the property supports, and we do that for our clients every day. So.
Great. Another question. What are you seeing in terms of origination fees on bridge loans of plus or minus 3 years?
Typical origination fee on a bridge loan can be anywhere from 2 to 4 points, depending on what type of lender you're able to place it with. We've seen them as low as 2 and as high as 4, and that's pretty common. Liz, did you have any other thoughts on that?
No, I mean, it's the origination is going to depend upon whether it needs to go to a conventional bridge lender or a hard money bridge lender. The hard money guys, private money lenders, are much more expensive. So, you know, as Georgia mentioned, we see bridge funds with origination as low as 2%, and we can honestly tell you there are guys out there that are lending private money up to, you know, 6, 8 points origination, and we usually try and steer clear of those unless kind of the lenders of last resort. That means that the property can't receive conventional bridge financing.
Okay, great. We have time for one more question before we close today's webinar. Last question is, can you offer some tips on refinancing a defeasance loan in 2012?
The tip on that is to work with a professional defeasance company. There's a couple that we could refer you to speak with and make your own determination as to which is the best fit for you. But those are complicated transactions, and you really need a specialist.
Liz, anything on that from your end?
Yeah, no, I think I agree with Georgia. We would recommend that you know, your number one option is you can wait until your defeasance period ends. And number 2, there are defeasance companies that you can talk to about getting out of that loan if you need to. And they do the calculations for you and let you know what kind of penalty and how much that's going to cost you. And then we would work with that company to kind of compare if you were to wait. And, you know, obviously we have to make some assumptions, but if you were to wait and get a higher rate later versus paying the pre-penalty now and getting a lower rate, and you can kind of take a look at those side-by-side comparisons. So that's something we can help out with.
Wonderful. Well, thank you both for a very informative webinar. We'd also like to thank everyone who attended today. We hope we've provided you with useful information to assist you in your investment, developing, and obviously financial endeavors. You will be receiving an email with a link to the archived presentation and a special offer, so watch your inbox for that. And last but certainly not least, for more information about our upcoming webinars, please visit our website at ministoragemessenger.com. Thank you to everyone for attending, and have a wonderful rest of the day.
Thank you.